Hello, my name is Joseph Slade. My final project is Factors Influencing Home Mortgage Interest Rates, specifically those purchased by Fannie Mae. The goal of this project would be to create a multivariable statistical estimator to predict interest rates offered by a loan originator, typically a lending bank. By creating this estimator, we were able to see how various factors numerically impact the offered rate, either positively or negatively. To achieve this, the dataset we are going to be examining is all of the loans acquired by Fannie Mae in the year 2015. First, a bit of background. Fannie Mae is a government enterprise that exists to purchase loans from other originators and then bundles those loans and possibly sells them off. Because Fannie Mae purchases a large number of residential loans, it ensures that originators will have a secondary market to sell the loans to after they are issued. Because this takes the risk off the originator, it helps encourage lending of home mortgages. In most cases, packages of assets held by a company are considered secret. They will not explain their purchasing decision beyond certain assets. However, because Fannie Mae is a government enterprise, they release a large amount of information to the public. This is why it is a useful source of examining loans, even though they did not originate with Fannie Mae. For example, we know that last year Fannie Mae purchased 1.8 million loans. Understanding what Fannie Mae is, it's now worth considering why the interest rate of a home mortgage loan is so significant. For an average American household, equity in their home is the single largest element of that family's net worth. Consequently, the interest rate offered on a home mortgage loan has a tremendous impact on a given family's ability to build net worth. For an average family with a $200,000 loan, for every 0.25% increase in interest rate, that family will pay $10,000 more over the life of the loan for no additional benefit. In addition, building up equity in a home provides a number of financial benefits, including the waiver of the need for mortgage insurance, access to low-cost equity-backed loans, and numerous others. As a result, the ability to quickly and easily build up equity in a property is of tremendous importance. However, even given the importance of these loans, the mean by which a given institution arrives at the rate they will offer a borrower is closely guarded. Most institutions even consider the way their terms are set trade secrets. While certain categories of information, race, gender, and religion, are protected categories and forbidden from consideration, outside of these protected categories, lenders have tremendous flexibility to adjust the rates as they see fit for a given borrower. Now on to the data set. If you go online and examine the data set, you will see that it's divided into two sections: origination and performance. Furthermore, inside of these two divisions, we are broken down into quarters, Q1 through Q4. Performance is a listing of how loans that have already been created are performing. Basically, are people making the payments they are supposed to be making? Origination is new loans that have been acquired in the given quarter. For the purposes of this examination, we are going to look at all loans that originated in quarters 1 through 4 of the year 2015, the last year for which all quarters have been published. Now this is a sample loan pulled from the data file. First, we can see there's a unique loan identification number. While easy for lookup, this will be ignored later on. Second is the channel, which is a category specifying what type or in which way the loan was acquired. We can see on the data set that the R means this is a retail loan. It was acquired from a retail loan offer, bank typically. Next is the name of the seller. Our data set has 38 unique sellers identified by name, each of these making up at least 1% of the loans acquired in a given quarter. Because whoever the loan originator in this case was is less than 1% of the data set, they are just simply demarcated by other. Next, we have probably the two most significant elements of any loan. the interest rate, and the unpaid principal balance, or in effect, the amount being borrowed. In this case, we can see the interest rate is 4.18%, with an unpaid principal balance just shy of $350,000. A final quick note. If you were to pull this dataset yourself, you would just see the loan information and not the header provided. I added this header to each of the files to make the subsequent data analysis a little easier for a human to understand. Before we can build our estimator, the raw data will need to undergo a significant amount of restructuring. For one thing, this dataset contains a large number of categorical variables. We will need to remap these. To do this, we'll take a categorical variable with n choices and replace it with n-1 binary identifiers. For example, the occupancy status variable could be one of primary, second, or investment, specifying if this is the home the borrower intends to live in, a second home, or an investment property. We will replace this categorical variable with the is second and is investment binary identifiers. In the case this is an investment property, we place a 1 for the is investment value and a 0 for his second. If it was a second home, we would place a 1 for his second and a 0 for his investment. And finally, if this is the borrower's primary home, we would place a 0 in both. Second of all, there are a variety of numerical values, all with different scales. We are going to replace these with the difference between a given value and the average value of that across the entire data set, and then divided by the standard deviation of that column across the entire data set. In this way, all of our numerical data will now share a standard scale. One column, though, requires special explanation. Every loan has a primary borrower's credit score. About half of loans have a co-borrower's credit score. There does not appear to be a consistent pattern between co-borrower credit score and primary borrower credit score. In half of all cases, it was higher, and in another half, it was lower. To accurately track the relationship between these various credit scores, a new column was created called average credit. In the case without a co-borrower, this was simply the primary borrower's credit score. In the case with a co-borrower, this column is the mean of the primary and co-borrower's credit scores. This will turn out to be a very predictive column later on. The full code for how the data was restructured will be included as an attachment in this project. Now that our data is nicely normalized, we can actually build the statistical estimator. Before going further, we should note that I've set aside a random partition of 10% of our data to use for testing that will not be used in the building of the model. We could have done multiple bootstrapping or k-cross validation for this. However, with a dataset this size, it seemed unnecessary. So we just went with our naive partitioned dataset. Now, we take the 90% remaining in our dataset, put it into the training, and there we feed it into the GLM function. Now here is the equation for the likelihood estimator. This is the equation the GLM seeks to maximize over our data set. Below that, we can see what an example of f of x sub I given theta below. Every independent variable is given some weight theta. Without knowing what distribution our variables are drawn from, the GLM asks us to pick. In this case, we're using the Gaussian distribution. Looking at some histograms of our source data, we can see this is a reasonable, if not great, assumption for our variables. Now, given this, the GLM function will attempt to find values of theta that maximize the likelihood estimator over the entire data set. It is important to note at this time that we have made a number of simplifying assumptions, namely GLM, general linear model. We are assuming our function is a linear combination of our variables. They are all independent, and they are all linear in the final variable. This is almost certainly not the case, but without a deep domain knowledge, it is unsure what the combination would be. And randomly specifying combinations of variables would take us from 24 independent variables to 441 just to have second order terms. Now that we have this model, it's worth asking how good a fit is it for the data we have. Now, we know that GLM seeks to maximize the probability of correct prediction across the data set, but to get a quick guideline on how good a fit it is, the mean squared error on the model is a useful, simple metric. However, without a point of comparison, we're just looking at arbitrary numbers. So we're going to compare versus a theoretical model that just returns the average value for every prediction. So Our theoretical average model has a mean squared error on the entire data set of a little more than 1. You can see it here. And the model that GLM has derived for us has a mean squared error of 0.3737. So it's about a third of a standard deviation away from the proper interest rate with every prediction. This is a pretty significant increase in accuracy over our very simplistic model. So it seems at least there is some validity to our approach, even considering the number of simplifying assumptions we've made. Now this is dangerous in a multivariate situation, but it helps to illustrate our point. Here we see a quick graph of our loan term versus the interest rate. You'll understand why I pick these variables in a moment, but here visually we can see a very clear indication where as the loan term value increases, so does the interest rate, and our estimator appears to mimic this. And again, here we can see this a much messier version, but still trending in the proper direction of our interest rate versus average credit score. Without further ado, here are the values of theta the GLM function assigned for each of our variables. It is important to note here that positive values correlate with a higher interest rate and negative values with a lower interest rate. So we can quickly see that a number of factors have little to no influence, including all the origination and even the loan to value. The most important negative term is the average credit value we created earlier. This makes intuitive sense. If everyone in the loan application has very good credit, you'll be offered a better interest rate because you are considered a lower risk of default. Of the positive factors, the single largest numerical factor is loan term. Again, this makes sense. The longer the loan term, the greater the length of money the lender's money is at risk, therefore the highest interest rate that will be needed to compensate for this increased risk. Knowing this, you should now understand the reason why we picked average credit and loan term as the two values to plot versus interest rate for our previous graphs. These were the two numerical variables with the strongest correlation between interest rate, showing the best signal. Looking at our categorical variables, we can now see that loan for cash out, a loan for a condo, a loan for a manufactured house, a loan for multiple units, or a loan for investment all have large positive values. In fact, the is investment variable is the single most significant factor in our model. This suggests that in general, lenders are very happy to lend to a single person or family purchasing a home to live in on a piece of property and much more hesitant about loans for other purposes. Having built this model and shown it correlates relatively well with our data, we come to this final analysis. Number 1, credit score is crucial. The better the score of everyone involved, the better the interest rate. Number 2, investment properties are heavily incentivized to get. Number 3, the loan term, which is the single factor most borrowers have control over that can impact their rate. The shorter the loan, the better. Finally, relocation loans are treated much more favorably than other loans, which is a point I failed to mention in the last slide, but as we can see, holds very true. Now, given what's already been done, there are a couple of areas of future exploration that could be worthwhile. Number 1, nonlinear variable combinations. We assumed linearity and independence for all our variables in this model. It's possible we could get a much better model by relaxing these assumptions. Number 2, we only used a single year of data, 2015, because that was what we had available. It's possible that these trends are not consistent, and by exploring larger data sets, we could find out that. Third, and I think most interestingly, we abstracted out the lender. We actually ignored this in our data analysis. It's possible to go back out and segregate out by originating lender and determine if they're acting consistently, or maybe some lenders actually have distinct patterns of behavior that are different from the aggregate averages we're seeing here.